Real estate investment trusts, or REITs, have been one of the worst performing asset classes since the Federal Reserve began hiking interest rates aggressively in early 2022. In fact, between the beginning of 2022 and the beginning of November 2023, REITs have declined by about 33% on average. However, since then, with inflation slowing, the Federal Reserve not hiking any more interest rates, and the consensus increasingly that the Fed is going to cut interest rates sooner rather than later, REITs have recovered sharply by about 25%. Meanwhile, they remain undervalued relative to their net asset values on average, and therefore, between that and increasing expectation that the Fed is likely to cut interest rates in September, people expect, in most cases, REITs to continue rising moving forward. While I share this bullish view on REITs, I do believe that there remain some serious challenges for the sector, and so investors need to be very choosy about which REITs they buy in particular. Hey everyone, my name is Samuel. I recently launched my YouTube channel, so if you could please give this video a like to help me grow my channel, I'd be greatly appreciative. Thank you. So the biggest headwind still facing REITs in general is the fact that I do not think long-term interest rates are as likely to fall as short-term interest rates are moving forward. And why this impacts REITs is because REITs are much more sensitive to long-term interest rates than they are short-term interest rates. And the Fed only controls the short-term interest rate. Long-term interest rate is somewhat affected by the short-term interest rate, but it's also largely affected by market forces. So we're going to dig into that here. So there are two main reasons why I think REITs are more sensitive to long-term interest rates. The first one is that the vast majority of their financing is long-term in nature. Yes, they do have revolving credit facilities. They have some floating rate debt that is typically sensitive to short-term interest rates. However, most of their debt is typically long-term in nature. That's because their cash flows are also generally long-term in nature. And so they try to match those two together as best they can to create a more balanced financial profile. But the long-term debt that they hold is usually at the asset level, whether it be a mortgage on a property, or it could be at the corporate level with a bond that they issue to the market that could be for 5, 10, 15, 20, even 30 years in some cases. And so if long-term interest rates remain high, their cost of financing is also going to remain relatively elevated. The second reason why REITs are generally more sensitive to long-term interest rates than they are short-term interest rates is because of the long-term contracted cash flow profile that they have with most of their tenants, and in many cases with REITs. They're often viewed as bond proxies by the market because of that cash flow that they generate and then the dividends that they pay out to shareholders. And so when interest rates, especially long-term interest rates, are higher, that means that the market generally expects a higher dividend yield, a higher cash flow yield from REITs. And so their share prices typically get suppressed when interest rates are higher for that reason. Now, why do I think long-term interest rates are likely going to remain higher relative to short-term interest rates? Well, the first big reason is simply because the yield curve remains quite inverted. And when you have a sharply inverted yield curve like we have today, that means that the market expects in the future for either long-term interest rates increase meaningfully or short-term interest rates to decrease significantly in order to create a more balanced yield curve, because historically longer-term debt has a higher yield than short-term debt. And that makes sense because the longer term of a bond you buy, the greater risk you're taking on. So you need to be compensated for that higher risk and that higher delayed gratification, so to speak, on that money with a higher yield on your investment. And so the market currently has that inverted, so that needs to be uninvert. So that can only do that in two ways. One is either short-term interest rates can drop or long-term interest rates can rise. Now, I do agree that short-term interest rates are very likely going to drop over the next year here. I do think the Fed is going to cut some interest rates. However, to truly uninvert the yield curve and create a meaningful historical spread between the two, long-term interest rates really don't have much room to fall unless the Fed has to cut back to what it was at 1% or below on short-term interest rates, which I just don't see happening for the near future. And I'll get into that for a second. But that means that long-term interest rates, maybe they'll come down a tiny bit, but I don't see them coming down much. And in fact, if short-term interest rates do not come down as much as some expect, that the Fed has finding it hard, okay, we can't really cut because inflation is still being pretty stiff, then long-term interest rates may actually increase. And so that's going to be a headwind for the REIT space. Now, why don't I think that the Fed's going to be able to cut a lot, and why do I think interest rates are going to remain higher, especially in the long end of the curve? Well, the big reason for this is that inflation is being pretty sticky. Yes, it's coming down, but it's still around 3% on a year-over-year basis, and that's about a full 100 basis points above where the Fed's target rate is at about 2%. Now, why is inflation being so sticky, and why do I think it's going to remain sticky moving forward? Well, a couple of reasons. One is the AI boom. Yes, that's great. But right now, it's largely just investment in research and development, investment in building out the infrastructure needed, investment in training the individuals needed to create chips and to do the research and development for artificial intelligence applications. But meanwhile, we're probably at least several years away from really meaningful AI-powered tools that are going to be truly deflationary for the economy, taking root, whether it be like the Tesla bot or other AI-powered functions that will really dramatically reduce the cost of production. I just don't see those coming online for the next several years at least. And so you're going to have, for now, AI is actually going to be inflationary for the economy rather than deflationary. Another big reason to expect inflation to remain sticking higher for longer is the deglobalization of supply chains and production. So much of the world's production has been, or at least portions of it, key portions of it, have been concentrated in Asia, especially in places like China and Taiwan. But with the growing geopolitical tensions over there and the increasing risk of China invading Taiwan or at least blockading them at any time now, economies around the world are smartly beginning to diversify away from China and Taiwan. And so you have chip fabrication centers being built in the United States. You have things in Europe going up on that front. You have other forms of supply chains and other crucial production facilities and capacities being moved elsewhere outside of China and Taiwan. And that all costs money. It means that typically the production is at least initially going to be much less efficient. And you have just the disruption, the moving around of people and things. That's all inflationary. Additionally, you have in Europe and the United States, politicians increasingly calling for tariffs on imports from China because of the predatory pricing that they're engaged in. The government there in China is subsidizing some strategic industries like electric vehicles, solar panels, etc., in order to make those companies be able to produce the goods extremely cheaply, dump those products on American and Western markets, take control of those industries, and then they control the strategic industry. And so the U.S. and Europe are trying to combat that with some protective tariffs, which are also quite politically popular, at least for now. But those are going to be inflationary as well because, again, it's driving up the cost of goods and services. And so for all those reasons, I think that we're going to see, yes, inflation will probably continue to trend downward, but those are major headwinds for the deflationary trend. And so I don't see us getting inflation down to the 2% level anytime immediately unless we hit a recession or a depression. And that brings me to my second point of reason why investors need to be highly selective on what REITs they invest in, because I do see the economy slowing. In fact, I see us heading towards a stagflationary period with low growth to even declining economic productivity with relatively persistent inflation for the foreseeable future. And so REITs that are highly economically sensitive, such as hotel REITs and other REITs like that, maybe even some retail REITs, investors need to be careful what they invest in because those REITs may struggle during a downturn or at least a prolonged period of slow growth. And so what does that mean? Well, there are two sectors, really one sector and then one specialized REIT that I think is pretty attractive right now, both on a valuation basis and on being able to withstand these trends that I see hitting us. And the first sector that I really like, the main sector I like right now, is multifamily real estate. Now, yes, there's some overbuilding in various markets in the United States. However, there remains strong demand for residential real estate in the United States. Residential real estate shortage is a crisis facing the United States. And especially in Sunbelt markets, especially places like Texas, I see a lot of in-migration continuing for years to come because the policies of the governments in Texas are very pro-growth, very low on regulation compared to many other states such as California, Illinois, New York. And so a lot of people are fleeing from those states that also have very, very expensive real estate, coming to places like Texas that have much more reasonably priced real estate and much more business-friendly climates. And there's also a big anti-property tax movement growing and gaining momentum in Texas. They already had some success this past session. I expect them to even have more success this next session. And so for those reasons, I think that real estate, residential real estate in places like Texas has a very bright future. And so, yes, there may be temporary overbuilding, but that's expected to work its way through pretty soon. I recently posted a video, and I'll link to it below, where I discuss my favorite residential REIT that can benefit from these long-term favorable trends in Texas and withstand the current headwinds. So I'll link that below. You can check it out for yourself and learn more about that really good opportunity. But bottom line is I like residential real estate because it has, especially multifamily, because they're short-term leases, typically a year, maybe a little longer, maybe a little less. And so if there's inflation that's elevated for a period of time, those rents can roll over pretty quickly. And so landlords can hike their rental rates pretty fast. There's a lot of turnover in a multifamily complex. So all the time there's turnover. So they're constantly able to increase their rents to help keep up with inflation instead of being tied into fixed or low contractual rent escalators each year that fall behind inflation. So you're preserving your cash flow power relative to inflation. And also, they generally are pretty defensive because especially Class B real estate, it's not very expensive. You've got to live somewhere. And if anything, multifamily is cheaper than single family. So during a recession or slow growth of an economy, Class B multifamily real estate is a great place to be. Now, the other type of REIT that I really like right now is WP Carey. And the reason I like WP Carey is it's well positioned to thrive during a low growth or even a recessionary environment because of its long-term triple net leases to broad diversified portfolio of individual tenants. It invests in high-quality, mission-critical real estate in favor sectors like industrial warehouse, mission-critical retail, private storage. Has a great track record of doing very well during economic downturns, even during the COVID downturn. WP Carey is one of the best-performing triple-net lease REITs out there. But at the same time, unlike the vast majority of its triple-net lease peers, the majority of its rental income comes from CPI-linked leases, which that means if inflation remains higher for longer, so will their organic growth on a per same-store basis. Whereas many of the triple net lease REIT peers like Realty Income or EPR Properties or Essential Properties Trust or NNN REIT, et cetera, they all have contractual fixed escalators. And so it's like every year 2% or 1% or whatever it may be, rent goes up for their tenants, whereas WP Carey, the majority of its leases actually increase in line with CPI. So if inflation is elevated, so will their rent growth be. So I really like that balance that they have. They also have a BBB plus credit rating from S&P, which is one of the best in the sector, gives them an attractive cost of capital. And so for all those reasons, they have a really good dividend yield. They trade at a discount to net asset value, at least they did recently, and went right around it. So there's a discount to their historical average of trading actually at a premium to their net asset value. And so for those reasons, I think it offers attractive risk-adjusted returns in the current environment. So there you have it. I hope this video was helpful for you. I hope it gave you an appreciation for, yes, REITs do have some things going for them. I do think rate cuts are going to be perceived by the market as bullish and likely send REITs a bit higher. However, you shouldn't just blindly buy the REIT sector and expect everything to be great. Long-term interest rates are a very important thing to keep an eye on. And I don't think that they're going to go as low as people think because of, the persistent inflation, and also due to the simple fact that, the U.S. government is borrowing a lot of money right now. And so you have China, you have a lot of other international borrowers, you even have the Fed that are no longer buying those long-term treasuries that they used to. So now there's this huge supply glut, even as demand for it is going down. And so that's going to cause interest rates on the long end of the curve to rise as well. So again, I wouldn't be too excited about prospect of long-term interest rates dropping. And that's what's ultimately going to matter for REITs in the long term. So given those tempered expectations, insist on REITs with good balance sheets and REITs that can thrive in a stagflationary environment like multifamily, Class B, and Sunbelt markets, and WP Carey. So if that was helpful for you, I'd ask you to please subscribe to my channel. Share with me in the comment section below what do you think of these opportunities, and if there are any other REITs that you like right now. Thank you very much. See you next time.